where for the assessment year company has paid book profit tax, it is entitled to a credit. So what is the credit available? The credit is the difference between book profit tax paid and normal total income tax. So what is the book profit tax paid? 100 lakhs minus normal total income tax. This credit, the life of the credit is 15 years. Leave 21, 22. 15 years na assessment year 36, 37. Till that time the credit will have life. Sorry, come to assessment year 22, 23. Okay, here what happens? The book profit regular tax, book profit tax is 90 lakhs. Higher normal total income tax on normal total income. So only is payable the credit supra normal income. But in such case, credit is available of only difference between normal total income and tax on book profit. What? 90 lakhs. What is the difference? 6 lakhs. To that extent only the credit is tax is what? 6. To that extent only set off 90 lakhs. You need to pay 90 lakhs. So the credit, once you set off 6 lakhs, the credit that is only 14 year 36, 37. In which year how much credit is available, in which year the credit is available for set off, in which how much set off is possible. Every tax regime it is deductible, but under the alternative tax regime, under 115 B also there is a reference to this section. It seems 115 BA, CCD is there. Under 115 BA or 115 BAA, or if you exercise the option under 115 BAB, okay, under these alternative tax regime, this expenditure is not eligible for deduction. This is not deductible. So if the assessee carrying on business or profession incurs any expenditure on notified skill development projects notified by the CBDT, expenditure may be capital or revenue under the normal tax regime, TRNA tax regime, it is deductible. But under the alternative tax regime opted for under 115 BA or 115 BA or 115 BAB, it is not deductible. That you need to note. Fine. Even 35 2AB BAA or 115 BAB. When you offer this alternative tax regime, this deduction is not available. That way you need to understand. Correct. We need to discuss about ATM. Detailedly in dividend chapter, but for the limited purpose I am covering Finance insertion. Finance Act 2020 insertion. Assessee is a domestic company. Dividend from another domestic company. It is getting dividend from domestic company, foreign company, a business trust. It is getting dividend. This dividend, obviously, it is taxable in the hands of domestic company. Is obvious. Now listen to me. In respect of this dividend, deduction, this is eligible for deduction under 80M. This is the conditions stipulated are fulfilled. Mostly taxable in the hands of the receiving company is fulfilling the conditions stipulated in 80M. Correct? Okay, eligible for deduction. Correct. Now, however, alternative tax for situation. Alternative for 80M deduction is available. Opted for alternative tax in B available. Where if you have opted for RTM comes in chapter 6, deduction under 80M is not available, or 150 heavy. To the discussion, even when you opt new deduction and consolidate up to this, okay, company, and it is it may be option, it should have exercise option under 115 BAE subsection 5 read with rule 21 AE. How the option is exercised? By uploading form number 10 IC electronically under digital signature within the due date for filing the return of income for the assessment year for which the option is exercised, and once the